Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we're talking about the world of robotics and automation with Bill Studebaker, the CIO and president of Robo Global. We talk about what is going on in the fast-moving world of robotics, some new areas that investors need to keep their eyes on, and a few individual leaders of this automation push as well. So, if you have any questions or comments, make sure to send them in to podcast@zacks.com, and don't forget to find the Dutram Report on iTunes and give us a review on over there as well. But stay tuned for my chat with Bill right after this. Okay, Bill, thanks for joining us today to talk about the exciting world of robotics and automation. It seems like extra focus has been put on this industry as of late, moving from just industrial to more of, say, a consumer or even job-replacing functions. Do you think this industry has sort of reached a critical mass as of late?
Yeah, well, it's a good question. Thank you for the introduction and having me. When you think about robotics and automation, it's really pretty interesting to kind of think about the recent developments that have actually occurred in robotics, automation, artificial intelligence, and machine learning have really kind of put us on the cusp of a new automation age. And, you know, in our opinion right now, there are kind of very few investment opportunities as compelling as this. And if we kind of think about robotics, AI, and automation, this isn't just a niche, but it's really a foundational technology that's being applied really to kind of all industries, all markets, and it's happening now. And so what's really happened is that there's been a massive inflection point in terms of the performance capabilities and the cost curve. And it's really now beginning to open up a whole new use case opportunity set that didn't exist years ago, but definitely exists now.
So what are some of these key growth areas for this market in the near future?
Well, if you think about, again, just logistics as an example, logistics automation, there's 17,000 warehouses and logistics facilities in North America alone, and less than 1% of them are automated. Amazon recognized that to be great at e-commerce, it needed to be great at fulfillment. So they actually bought a capability called Kiva Systems back in 2012, which is now Amazon Robotics. That's the 50,000 robots that do the fulfillment. Coincidentally, it was actually co-founded by one of our advisors and shareholders of our company, Raf D'Andrea. But the interesting thing here is that they really started out a robotics arms race. And for people that want to compete with Amazon, it's not about the cost. It's about delivery. So if you think about now on a go-forward basis, the growth that's embedded here for companies that need to be able to compete against Walmart in terms of, you know, automating their fulfillment systems, et cetera, it's pretty extraordinary when you think about the sort of ecosystem of technologies that support this, everything from machine vision to trace, track, and control to RFID to scanners to picking and sorting systems. So clearly a very dynamic area. It's going to be growing at 20-30%, you know, for years. If you think about autonomous vehicles, obviously there's been a lot of progress the last couple of years. 18 months ago, I don't think anyone really gave it much of a thought, but this is happening. And if you think about a world of shared autonomous vehicles where in the United States alone we spend $2.1 trillion on the cost of maintaining our vehicles, and 50% of that spend is captured, there's a lot of money up for grabs. That's going to be a very disruptive area in the years to come. If you think about manufacturing, we're actually going through a big change of mass production to mass customization. And that really can only be facilitated through automation. And there are technologies now, collaborative robots, that now have very distinct capabilities and massive returns on investment capital. Companies like Paradigm that bought an asset called Universal Robots has a collaborative robot along with ABB and a few others that has a payback period inside of a few months. So you can buy a collaborative robot that costs anywhere in the neighborhood of $25,000 to $40,000. It works 24/7, 365 days of the year with no health care, no overtime, that can be put on the end of an assembly line to do a specific function one day and then maybe do one the next day. The beauty of this technology is that these assets can be reprogrammed through hand or manual manipulation versus having to go through and do the physical recoding. Obviously, a disruptive capability. There's 6 million small to medium-sized global manufacturing companies throughout the world. The growth rate here for this particular area is going to be 50% plus for years.
So you briefly touched upon this, but there's this idea, robots don't need healthcare, wages, this sort of thing. Do you think rising wages in the general economy will sort of accelerate the push towards robotics and automation?
Well, I think it's definitely an element, but I think we outsourced all of our manufacturing overseas to basically cut costs, and that arbitrage is effectively gone. And so it's not just about cutting costs. It's really about, productivity and growth. I think there's certain capabilities that robotics has that is obviously much more efficient than what a human can do. And I think that what you're seeing here is the bigger thing is not the cost savings, but it's really the productivity and the growth. And I think as we learn how some of these technologies can be integrated into manufacturing and other areas, we're going to see dramatic growth. And I think that's the key thing that gets lost in the discussion about robotics. It's not just about the job loss. It's really about the new sources of growth.
So what is your take on the recent comments from Bill Gates that robots may need to be taxed in the future in order to better manage the shift in the economy to a more automated one? Do you have any opinion on that?
Well, I guess I do. It's certainly hard to be overly critical of one of the greatest tech visionaries of our time. Having said that, I think we have to recognize that robotics and automation is not something that's going to happen overnight. I mean, this is going to be an evolution for how this happens. And I do understand the risk of our economies becoming overly automated and effectively displacing a lot of workers. But I think if we have to get into a world where we're taxing robots, then we have to be in a position where we're taxing automation. I mean, we would have to be in a position to tax software companies because effectively that's automation. I think the lines get a little bit blurred here, but I don't think we're at a point where that is a real economic reality. I think it's interesting he brought this up, and I think it just kind of highlights what could be a potential risk, but that's my opinion.
So let's shift gears real quick and talk about the index your firm has to track this space, the RoboStock's Global Robotics and Automation Index. Now, this benchmark is the underlying index for the Robo ETF, and I wanted to get some insights on how this benchmark is created. Can you give us a look into how the companies are selected for this index?
Yeah, well, let me just step back and tell you a little about the evolution of how this happened. I guess the index launched roughly 4 years ago, and we did this really with the foresight and the intuition, I guess the luck, thinking that robotics and automation is really a disruptive technology. That very few people had kind of thought about it and had a profound potential impact on our economy. At the time we looked around, there weren't a lot of dedicated ways to play this. Certainly there were a few dedicated companies, the Rockwells of the world, ABBs that were focused on automation, FANUC, but there really wasn't any dedicated exposures. And so effectively we created one. And we did this with the help of some of the world's leading robotic thought leaders and entrepreneurs and financial people. You can take a look at our website for details in the bio at roboglobal.com. But our idea here was that we recognized that this was a global opportunity set. And for most investors, just investing in the U.S. would not capture the exposure. Interestingly, most of these technologies actually exist internationally. And so our index actually has 40% U.S. exposure and 60% international, not by design. That just happens to be where the assets exist. So what we did in building this index is that we tried to design a framework that's very objective and transparent. And we basically inform our decision-making we created our own classification system for robotics. Because prior to us doing this, it did not exist. And certainly a lot of these robotic companies don't exist in traditional Wall Street GIC systems. And so effectively what we did is we created a construct for this. We define a company as either a technology or an application. So a technology is simply what makes the robot work. It's the computing technologies, the processing, the sensing, the integration, the actuation. The applications are effectively the use cases, which we define as 8 different use cases that we think have the highest relevance to robotics, which are everything from ag to healthcare to logistics automation, manufacturing, industrial automation, security surveillance, to name a few, and healthcare. And so to get in the index, a company has to fit within one of our 13 different subsectors. We then run them through a rigid revenue analysis where to be put in, a company has to have a minimum revenue threshold that corresponds directly to robotics automation in terms of that is revenue that they have to be generating from providing a product or service that sells into robotics and automation. So not a company like Amazon, for example, that in our mind is not a robotics company. They just happen to use the technology to enable their business, arguably better than most companies in the world. But they have to be making money from it. We then apply filters that correspond to exchange traded eligibility and market cap and liquidity. And so the output we have here is an index of 82 companies. Again, it's 40% U.S., 60% international. It's multi-cap, it's 25% large, and it's 75% mid and small. The beauty of it is less than 2% of the companies crossover in any traditional indices. So whether that's the NASDAQ, the S&P, the MSCI Global, just as a few reference points. And most of these companies are pretty underfollowed by Wall Street. It's probably fair to say that of the bulge bracket firms, they probably cover less than 40% of these companies. So it's truly a unique exposure, and one right now that's really benefiting from an acceleration in growth. I mean, we're seeing this right now, and the performance of the ETF year-to-date is up around 15, 16%, or the index, the performance the last 52 weeks is up anywhere between 30 to 35%, really dramatically outperforming global indices because of the growth. And it's actually interesting to see the numbers that are coming through in the first quarter. There is definitely an acceleration in the growth across a multitude of companies in our portfolio. I did look at and did some research yesterday. 12 of our 13 subsectors have generated a positive attribution year-to-date. All 13 of them actually did last year. Only 10% of the companies, roughly speaking, have a negative return year-to-date. So really broad-based growth. I looked at the S&P. The S&P, 30% of the S&P had a negative return. So it is interesting to see that our growth is much broader based than the market, and obviously this is showing up in the performance.
So let's talk about some of the index components. I don't think anyone is going to argue with iRobot making the cut here, but we also see some large cap names that I think a lot of people might not be too familiar with being in this robotics automation space. Deere and Company, Northrop Grumman come to mind here. So it's just these companies have to have some percentage of revenue deriving from automation, and
Correct.
So it can just be a very small percentage, though, right?
Correct. So we define a company. We have an equal weighted position size. We either have what we define as a bellwether, which is a 40% of the portfolio, and a non-bellwether, which is 60% of the portfolio. Those are fixed parameters. The bellwether company has a 2% weighting, and non-bellwether has a 1% weighting. The bellwether company must have 40% or more revenue that comes directly from robotics and automation. The actual average for us for our bellwether companies is somewhere close to 70%, and non-bellwether has to have 10% or more. The average for us is probably closer to 25%. And so when we put some companies in there, Deere as an example is kind of an interesting case, was one of the early companies that we had put into the ag sector. Clearly we thought that ag was a sector that had some pretty significance as it relates to robotics and automation. Deere, interestingly enough, 65% of their fleet of tractors are autonomous or have autonomous capabilities. So it's actually one of the largest autonomous fleets in the world, and most people hadn't really thought about that. Companies like Northrop Grumman have roughly 10% of their revenue that corresponds directly to UAV technologies.
Yeah,
I hope that answers your question.
Yeah, definitely. I don't think a lot of investors out there would have known that about John Deere or Northrop Grumman. You did touch upon this a bit earlier, but I did want to take a little bit closer look at some of the international exposure. You said more than half the portfolio is from foreign markets. I'm guessing Japan is a big contributor to the index. Is that fair to say?
True. Japan is roughly around 25% of total exposure. So clearly there's a lot of assets in Japan.
So how do you think Japan has been so successful in developing its robotics and automation industry? It seems like when people think of the word robotics, Japan is one of the first countries that comes to mind. Is there something special that they're doing over there, or is something about the demographic picture that makes Japan such a unique case?
No, I don't really have a great answer for you on that, to be honest with you. I mean, that's obviously they've been early investors in the technology, and they've supported it throughout the course of the last 2 decades. Whereas in the U.S., there really has not been a big effort on incubating the technologies. I think one thing that's happened that's kind of accelerated, the growth of robotics in general is really the influence of what's called now the Robot Operating System, effectively called ROS. ROS is a open architecture. It's like the Linux version for robotics. It's an open shared platform that's supported by a lot of technology companies that now is allowing for there to be shared technological use. Typically before, what would happen is a university would get money, or someone would get money as a grant or whatever to develop a technology. Often they would run out of money and the technology would be obsolete or non-reusable. And now with an open system, there's a lot of shared technology. I think the Japanese have probably done a much better job in the past of actually sharing their technology internally. That's just my opinion. But clearly they've been focused on it. The U.S. does not even have one dedicated OE robotics company in the U.S. We have companies that are exposed to enabling technologies, but the big players are international.
Yeah, and I also wanted to ask about the process for adding or deleting companies from the benchmark. Let's say one of the companies in there right now goes from 10 to 15% in this automation robotics space, and then they drop down. They just sort of spin it off. They get out of the space entirely. How do you sort of manage these companies, remove them? And, is there a process for adding companies? Is it like a quarterly process, twice a year?
Certainly. Yep.
What's the process there?
So basically, we maintain a database of 1,000 companies globally that participate in robotics and automation. It's a database that one of our early founders began to originate close to a decade ago. And it's really a proprietary database where we track both private and public companies. So all of our potential constituents are in our database. We track them very carefully. And we're obviously looking for, companies that would fit within one of our 13 different subsectors and then have a revenue threshold that corresponds to, our requirements. So we're constantly paying attention to this and filtering the companies through it and paying attention to where their revenue mix is. Again, a lot of this does not show up in traditional Wall Street research. It takes a lot of work to go through and determine where these companies and these technologies exist and where the revenues are. So we pay close attention to it. And so the index rebalances, quarterly. A company obviously will go in when we determine that it has a high enough revenue threshold. Since inception 4 years ago, we've had roughly 31 portfolio changes. I would say 8 of those have been a result of acquisition. Roughly 10 or so have been a result of being kicked out of the portfolio because of weakening liquidity. We may have had a company that's gone in there where the market cap went below a certain threshold or where the volume dried up, and so that triggered a sell. So we had roughly 10 of those. So we really have had roughly around one new name per quarter. And again, quarterly, we review the portfolio. We have an index committee that focuses on that. All of our robotic experts, advisors, participate on the index selection process.
So last question, is there any particular area you think robotics automation investors should focus on for the second half of 2017, or anything else people should know about this industry in general?
Well, I think what they have to realize is that we really are at a fundamental tipping point. And I think most investors are not aware of the undercurrent of change that's going on. Since 2012, there have been over 400 venture fundings in robotics companies globally. There have been upwards of 1,200 AI fundings. There were 280 AI fundings in the first quarter alone. So there is a lot of disruption going on, and we think it's definitely early days. To pick the obvious winners and losers, we think it's going to be fundamentally challenging, and it's very difficult to pick the subsectors that may outperform what and when. We think the best approach here is the index approach, where what we've tried to do is capture the entire ecosystem of companies and not try to pick what we think would be the winners or losers. We think if you study the big moves that sectors have had historically, whether it was the financials in the 80s, the dot-coms in the 90s, really technology in general since 2009, what the biotech index has done since kind of 2010-11, the moves here have been pretty magnificent. And so we think that, again, trying to pick the obvious winner, loser is tough. Very few Investors probably anticipated where Amazon is now and what they've become. Even Google, back at the time of the IPO, there was a lot of concern about it being overvalued and could they ever grow into their growth. It's hard to know, and we think the best approach here is the index. The biotech index, interestingly enough, from 2012 to the summer of 15 went up roughly 275%. During that period of time, only 15% of the individual constituents outperformed the IBB. So by mathematical computation, 85% of the companies didn't. Interestingly, 25% of the companies had a negative return. So in the kind of embarrassing in a sector that had, like the biotech, that was the best performing subsector for 2 years in a row, you could have had a kind of a poor return if you pick some of the losers. And so, again, we think the index approach is the most interesting, and we think that the growth potential for robotics and automation companies is good or better than anything out there in the market.
Yeah, definitely. That's a good point about the single stock risk that you can get in some of these higher growth areas. Well, Bill, thanks for coming on to talk about the world of robotics and automation. Definitely an area that investors need to pay attention to in the future.
Thank you very much.
All right, everyone, that was Bill Studebaker, CIO and President at Robo Global. You can check out more information regarding their index and research on the robotics and automation industry at roboglobal.com, and the ETF that tracks this benchmark goes under the symbol of Robo. Well, hope you enjoyed this edition of the Dutra Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Dutram Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment on Facebook too. And be on the lookout for a new edition of the Dutram Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutram.